Hey guys, what is going on? So I wanted to explain what I have been doing over the past year, kind of how my outlook has changed a little bit, how I've changed strategies to some extent, how I've kept some things the same, and just kind of give an overall update now that we are in a recession. So 2 quarters of negative GDP growth, that's the standard definition of a recession. Now, people are trying to make it seem like we're not in a recession, but let's just call it what it is. So I think there's a totally different perspective from where I have been at over the last year and where I'm currently at versus the videos that I used to put out. So during the time period that I, started making videos, I had been a very successful trader in a, yes, a bull market, but nothing abnormally crazy in terms of returns. And I felt like I had something to bring to the table in terms of a different perspective on trading. The way that I did things, I think, was a little bit unique. I had a lot of people ask me, because I did have a lot of success prior to making that channel, how did I trade and stuff like that. So that was kind of a video series of me just kind of explaining how I traded, and that turned into a channel. Then, COVID happened and the market just was totally irrational, in my opinion, in a overly bullish perspective. And it took me a very long time to adjust to that. And I was using my old strategy that just didn't really work out very well during that time period. Now, I did have my ups and downs. I did have time periods where I made a lot of money. I had time periods where I lost a lot of money. Obviously, that was all available for everybody to see as I documented every trading video for like a year. So I think I have a different perspective now. And considering we are in a recession, I kind of wanted to talk about how my perspective and strategy has changed a little bit, how things have stayed the same, and kind of my philosophy in terms of why I trade and why I approach things the way that I do in the first place, and not just, picking index funds. So the first thing I do want to talk about is that whole index fund thing, in terms of if you look at, the S&P 500, or if you look at the Dow Jones or something like that, please look at the last 20 to 30 years, the performance that those indices have had. And then look at things like the Shiller P ratio for, the S&P 500. Look at, historically what the stock market has done versus what it's done in recent years. Look at how we've had, a .com crash, how we've had the 2008 recession, how we had the COVID drop, and how we're now in another recession, right? So look at the activity that's happened over the last 20, 30 years, and actually digest that and see, okay, where are we going in terms of population growth as a country? Where are we going in GDP growth as a country? Where are we going in terms of valuations from PE ratios? That's how things historically have been valued. How have we deviated from that? And then look at all that and then tell me that an index fund would be even remotely close to a good idea. That's my philosophy. Now, that may be a very divisive opinion, but that's why I trade. I do not think that this 10% per year thing is even remotely guaranteed, nor even necessarily true in recent history at all. So I don't know why people just keep spitting that out. And, whenever you're a trader, I'm sure a lot of you guys who watch my channel are traders. You've probably heard a lot of people dissing trading, or, oh, you're a penny stock trader or whatever. And it's like, what has worked in America in the last 100 years has not even worked in the last 20, 30 years. And it's definitely not at these valuations going to work in the future, in my opinion. If you look at the current valuations that we have in a recession, significantly off all-time highs, they still do not look appealing. Okay, so that is my philosophy in terms of trading, and why I do it in the first place and why I spend time doing it. Okay, now in terms of what I've been doing over the past year, what my portfolio has kind of done, it obviously has not been good. So you guys probably know me for being a huge golden nugget bull, and I to this day still am, although it is no longer a stock that you can trade. It was bought out by DraftKings. So basically what happened was, when that was announced, Golden Nugget went up. I made a little bit of money on that, but the rest of my portfolio is not doing all too hot because the market has been dropping, or my portfolio has been dropping since February 2021. So I made some money back, but it wasn't even break even. I was still down. So that obviously wasn't good. And at the time, I didn't want to buy DraftKings for the valuation that it was, considering what it was doing. Now, fast forward up until the last few months until the actual merger happened with Golden Nugget and DraftKings. That is when I decided to start buying DraftKings. So that is a way for me to own Golden Nugget at a very low valuation. They basically got it for, I would consider pennies on the dollar, considering what I thought it was worth versus what it was kind of gotten at from a share perspective, as well as the continued drop in DraftKings since that actual merger happened. So basically Golden Nugget is, in a way achieved through buying DraftKings, which, I would buy a ton of Golden Nugget if it was still that same stock at that price. But considering DraftKings is significantly down from its all-time highs, I am now bullish on DraftKings, especially considering it now owns Golden Nugget. So that is my biggest holding. And I do have another portfolio. So I don't plan to do the whole daily trading. I don't even know if I'm going to make another video, but this is just kind of an update on what I have been doing. But DraftKings is my biggest position. I'm obviously still very bullish on the Golden Nugget sector of that. DraftKings in particular, not as bullish on that. But considering the valuation, I do think that it is a solid buy at this price. So that is my current largest position. And then my second largest position is Hims and Hers. So that is a stock that I pretty much loaded up on that one at the bottom, to be honest. I was getting into some other very volatile stocks that have since lost a lot of value. And at that time, I just wanted to buy, less risky things that I considered to be more of a solid bet, and I considered Hims and Hers to be one of the most solid bets that I could find. So I started loading up on that one. Very good timing on that. And DraftKings, I started buying that right around the merger. I think it was around $17. So I think it's like 13 and a half right now. So that one is down. Hims and Hers, I think I'm overall up on that position. If you guys remember way back in the day from my channel, I was bullish on Hims and Hers way back before it even merged. So the fact that I was able to scoop some shares up, or, I got some options contracts, but the fact that I was able to do that at around $3, I think is a very good price, and I'm very happy about that. And then outside of those two, those are my two major positions. Then I just have things spread out across a couple different stocks that are a little bit more high risk. So some of them are like Smile Direct Club, which has lost me a lot of money. Clover Health, which has also, I think, lost me a decent amount of money. And then I'm building out a position in this company called Perion. I have a small position in that, though. That's one that I'm bullish on. I don't think it's as good of a deal as DraftKings, or more specifically Hims and Hers. That is my favorite stock from like a valuation, and that's a company that I really, really like. That's what I'm most bullish on. But the reason that it's not my largest position is because my new strategy has basically been poor man's covered calls. And I've kind of talked about this on the channel before. I've talked about why I did that. So what I was doing after I stopped the channel was I was just buying shares of companies that I liked and then selling covered calls against those. Margin calls continued to happen as stocks continue to fall. Obviously, some of the stocks I own were down like 80, 90%. So yeah, obviously margin calls continue to happen. I continue to lose money on those. And I basically just switched to Leaps contracts because you can't get margin called on those. You can still have that leverage, and then you can take advantage of the covered call premium that you can collect. And that's my current strategy that I've been doing for several months now. So currently my portfolio, so I have my Robinhood portfolio, that's the one that you guys all saw. That one is down over 50% probably from when I started making, or when I stopped making videos. So that one is not doing very good, but that's not my largest portfolio, because I've actually been adding to my secondary portfolio, which is on TD Ameritrade. And that one is down less than 50%. So it's doing better. I've been buying the dip on that, and I have made some money on certain plays on that, so it's not as devastating. And the fact that I'm able to buy the dip on that one, that's where I'm putting my money. Obviously, I'm able to dollar cost average in that account. So basically, kind of the perspective that I wanted to give here is that, obviously I talked about indexes and why I don't think they're a good idea. I talked about why I think, the current stocks that I own are a good valuation. I think those are down, obviously a lot of the stocks that I own are down 70, 80, 90%, maybe not 90% anymore because we've had a bit of a bounce. But, to go to an index that was overvalued in the first place, have that drop 20% versus have a stock that was probably a good valuation, then have that drop like 80%. Where do you think my money is going? Obviously, no money in indexes. And then I think that considering we might have already bottomed in the stock market, I'm not saying that that is 100% a fact, but it is starting to seem that way. Being leveraged in these positions is much better than being leveraged at the top. I'll tell you that right now, because I lost a lot of extra money being leveraged at the start of the crash versus what I would consider to be hopefully the end of the crash. So I'm not saying to be leveraged. I'm not saying to do poor man's covered calls. I do think covered calls in general are a good option. However you want to do that via buying shares, using margin, poor man's covered call, however you want to do that is up to you. Obviously, I'm not a financial advisor, as I've stressed many times, but I think there is a tremendous amount of money to be made from the bottom here, even if you're just buying shares. But if you take advantage of the premium that you can, utilize by selling covered calls, and then utilize leverage either via margin, which is probably a bad idea, or, in my case, doing poor man's covered calls, I think the amount of money that you can make from the bottom and bouncing out of this is absolutely insane. And that's why I wanted to make this video, because this is like, in my opinion, a once in a lifetime opportunity. And I think that, I have the perspective of seeing this as a blessing. Other people are probably so far down in their portfolio that, they're not seeing that as a positive thing. But I think it's really positive. I think I'm going to make a lot of money from this bottom. And I just wanted to share that kind of perspective. And, I really think that this next, 12-month period could be the difference between you potentially not buying or selling at these prices, which I think would be a grave mistake. It could be the difference between that and, making life-changing money. And I think I needed to make this video for that. I don't know if I'm going to make another video, but I just wanted to put this out there for people who wanted to hear it, who needed that, positive, perspective. And then for those of you who maybe were trading this last year, lost all your money or lost a good chunk of the money and think, oh man, I should just switch over to the indexes. I really don't think that's a good idea. I don't think that the indexes are going to be beneficial from a holding perspective relative to any like educated trading for the next, I think for the remainder of my life, to be honest. I don't think that they're a good valuation. I don't think that we've seen economy growth, population growth, GDP growth, whatever you want to look at. Or even if you, again, go back for the last 20, 30 years, look at the performances of these indices and look at the percentage that they talk about where it's like, oh, it's a guaranteed 10%. Well, go back in time and look at that and tell me if that's true. And look at, the recessions and the periods, and people could just be like, oh, well, we've had all these negative things over the last, 20 years. That's why we're not as high as we could be. Do you really think that's the case, or do you think that the American economy that we saw back in the day was just growing at a rate when we had much higher birth rates, higher GDP growth? Like, do you think that that is sustainable? Like, do you think that, this is an example that I use, Apple was a very well-established company before, the iPod and the iPhone and stuff like that. And even, after those were introduced, it was still a very valuable company. It traded at a 15P ratio, whatever. And they literally rode, and tech stocks in general rode such a massive tech boom where not only did tech take over the world and those became the most valuable companies in the world, but the valuations of tech companies are now like, 30P ratios as opposed to, the old school like 15P ratio. And so the valuations have skyrocketed dramatically, and this influences the S&P 500 and stuff like that. Do you think that that is something that can just continuously happen? I mean, I think the returns that we've had in recent years outside of tech stocks have been, not very good. And they've basically carried, the U.S. economy. And do you think that that can happen at the same scale? Do you think that Apple can go from being a well-established computer company, potentially in the early years of the iPod and the iPhone, do you think it can make that massive jump in valuation and then have, other tech companies go along with it when we've had this massive transition from cell phones being pretty much something that was kind of like a niche product not that long ago to literally being everybody's on their phone and tech dominates everything. Do you think we're going to have another one of those that's going to prop up the economy, or do you think it's less realistic to expect something like that? I mean, these are just things that I think people don't think about. They just think, oh, you know, the market goes up over time. Really think about what you're doing right now, because there are other times where it's like, okay, you could have got in on this stock, you could have got in this stock, you could have bought Bitcoin or whatever, and the S&P is going to, you know, grow slowly. But now we're in an opportunity where we are literally in a recession. We, you know, have some of the best prices, discounts that we've seen, you know, probably since 2008. You know, we had the COVID, you know, drop and stuff like that, but I don't think the discounts were quite as juicy back then, considering, you know, what was happening and, you know, what we kind of considered the future might be. We can go back to the dot-com crash. If you look at how history has kind of been over the past 20, 30 years, where have the opportunities been? It's been after those crashes, and it's been in sectors that are going to see that growth. And you can't just think that tech as an entire multi-trillion-dollar sector is going to have that same ability to prop up the market as it has the last 20 years. I just don't think that's realistic. And I think this is really like, if this is a paradigm shift for you, I really hope that it can be. To think that like just investing in the market and just expecting a very passive style of investing is just not realistic to yield you very good results. And I think that has always been true. I've always believed that. But the fact that we're seeing these prices and we're in a recession, we have this opportunity that I've never seen an opportunity like this in my entire trading career. Now is the time to make this realization. Now is the time to have the paradigm shift. If in the past you were investing in these risky stocks, you know, the last 12 months, you probably did a lot better holding an index than you did those stocks. Okay, so it wouldn't have been as urgent to tell you this a year ago, or back when markets were at all-time highs, or back when FOMO was happening and Lucid Motors was going from $10 to $70. Probably not as important to tell you at a time like that versus a time like this. So I think this is probably the most important video that I've ever made. And I don't know if I'm going to make another video, but I just really wanted to put this out there because I think people need to hear this. And considering I had a platform, I don't know if anybody's going to watch this, but you know, if you do, I appreciate it. I'm not trying to regrow this channel or revive it or anything like that, but I do think that I have a responsibility to put this video out, both to explain, you know, what I've been doing the past year, my philosophies, and hopefully this can be something that helps people. So that's all I'm really doing this for. Remember, I'm not a financial advisor. Any risks that you take are your own, and you are responsible for your own money. So with all that being said, I don't know if I'm going to make another video, but felt like I needed to make that one. So might, hopefully, maybe, probably not. Talk to you soon.